Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at cbdMD.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For you, the core story we need to unpack here is it's a real turnaround attempt for a branded company in the CBD space.
Okay.
After years of pretty steep decline, we're finally seeing what looks like a major stabilization point. And that's the foundation for any kind of investment thesis here.
Stabilization, that sounds like the opposite of growth, which usually isn't what people look for in a stock like this. So we need to understand why flat is like the new up here.
Exactly. It's all about context.
Yeah.
So if you look at the preliminary sales guidance for fiscal year 2025, it's projected to be between $19.1 and $19.3 million.
And how does that stack up?
Well, compared to the $19.5 million they did in fiscal 24, it's essentially flat. And if this were some mature, stable company, that would be, frankly, boring. But here, it's monumental.
So why is flat monumental? What's the story behind that number?
Because it stops the bleeding. I mean, we have to remember where this company was. The revenue shrinkage was dramatic. In fiscal 24, revenue was down a steep 19.4%.
Wow, almost 20%.
Yeah. And if you look at just the last 12 months, that decline has slowed to only about 9%. So that deceleration, that slowing of the loss, is the first real sign that they're executing. They're finding a base.
That reframing helps a lot. So it's a move from, let's say, survival mode to actually stabilizing the business. But are there any, green shoots of actual growth on the horizon?
That's where the narrative gets genuinely compelling. Management is actually projecting that Q4 of fiscal 25 will show the first clear quarter of year-over-year growth.
Okay, actual growth.
Forecasted to be a 3 to 5% increase. They're guiding for Q4 sales between 4.7 and 4.9 million against 4.6 million in Q4 of 24.
So seeing that, even if it's modest, it proves the strategy is working. The one they call profitable growth.
Right. And that pivot is key. It's not just about the top line. It's what's happening on the bottom line that's so impressive.
Let's dig into that, the profitability story, because that's where the cost management narrative really comes into play, isn't it?
It's a fantastic story of operational efficiency. Management's focus has clearly been on expenses, and it's bearing fruit right away. The net loss for fiscal 25 is expected to improve substantially. They're guiding for a loss of between 1.9 and 2.1 million.
And that's what, roughly cutting the loss in half compared to the 3.7 million they lost in 24?
Exactly. Cutting losses in half on basically flat sales. That tells you everything about the fat they've trimmed.
Okay, but how do we know this is sustainable? Is it just random cost slashing or something more strategic?
And here is the single most important metric that supports the idea that this is strategic. The gross margin. The company cites a robust gross margin of around 61.2%.
61%. That's an absolutely massive number, especially in a sector that can be pretty commoditized. Why is that specific margin so critical?
It's the anchor of the whole thesis. When you see a margin over 60%, it tells you two things. First, they have real pricing power. And second, they're competing on brand and quality, not just on being the cheapest option out there.
So they're a premium product, not a commodity.
Precisely. It validates the brand equity they've spent years building, and it gives them a competitive moat that smaller players just don't have.
That's a crucial distinction. But, I have to be a bit of a skeptic here.
Yeah.
If they could cut the loss in half so quickly on flat sales, doesn't that suggest they were just wildly inefficient before?
That's a fair question. The critique is valid. It does suggest a lack of discipline historically, but the market looks at execution now.
Sure.
And we can see that in the quarterly trends. For instance, Q1 2025 EPS came in at negative $1.76 versus the consensus expectation of negative $2.96.
That's a huge beat, almost a 41% surprise on the cost side.
It is. And that reinforces the view that the current team is executing effectively. They're under-promising and over-delivering on loss reduction, which builds back credibility.
Okay, so the operations are tightening up, but all of this was under a huge shadow until very recently, right? We have to talk about the NYSE listing issue.
This was the major immediate catalyst, the elephant in the room. For months, the company was non-compliant with the exchange's listing standards.
And that means a delisting risk, which scares everyone away.
Absolutely. You can't attract serious capital if you might disappear to the pink sheets.
So how did they fix it?
They did two things in September. First, a Series A preferred share conversion, and second, a capital raise. Together, those moves resolve the deficiencies that the exchange had flagged.
And for the listener, why does that matter so much?
Because it removes a massive risk premium from the stock. The market can finally stop worrying about delisting and focus on the operational story we just discussed. It also strengthens the balance sheet, which is critical if you ever want institutions to get involved.
Okay, so let's shift to financial health and valuation because this is where I think the asymmetrical opportunity really shows up. Their liquidity looks manageable. A current ratio of 1.6, that's stable enough.
It is. But when you look at the valuation multiples,
Yeah.
it gets a little crazy.
Yeah, the price to sales ratio is extremely low. It's in the, 0.03 to 0.56 range. What does a number that low really mean in practical terms?
It doesn't just suggest the company is cheap. A valuation that low means the market has priced the equity for, well, near complete failure, maybe even bankruptcy.
So the bar is incredibly low.
Incredibly. When a company is valued this low, any modest success like just hitting their guidance or generating even a tiny bit of positive free cash flow can lead to a nonlinear exponential reaction in the stock price. The starting base is just that depressed.
So if they just execute their plan and stay listed, the market has to re-rate them potentially multiple times over.
Precisely. And that brings us back to their advantage. They have that 61% gross margin because they're a brand. They're one of the better-known CBD brands in the U.S.
And that brand equity, plus the NYSE listing, is a huge strategic edge over all the private or OTC competitors.
It's a huge moat. Better access to capital, better terms with vendors, and, maybe even the ability to do some M&A down the line as the sector consolidates.
And we saw the market react instantly to this, didn't we? The technical action after the compliance news was dramatic.
It was incredible. I mean, reports were citing the stock moving 70, 80, even 90% in a single day on massive volume.
What does that kind of sudden explosion tell you?
It tells you it's a classic early-stage turnaround pattern. That spike wasn't just new buyers, it was a massive short covering. People betting on failure were forced to close their positions, which just amplifies the whole move. It signals a potential trend reversal.
Okay, we have to do the balanced view now. The turnaround isn't a done deal. Let's talk about the bear case and the risks that are still very much there.
Absolutely. It's crucial. We can't ignore that the company still has negative net margins, and EBIT earnings before interest and taxes is still negative. So structurally, the core operations are not yet profitable.
And there's the history, right? Years of revenue decline, cash burn. Some traditional screens still flag this stock for poor momentum because of that history.
That's right. And it means management has to constantly fight for credibility.
Mm-hmm.
However, you have to look at the mitigating factors. A lot of that bad news is already priced in.
Mm-hmm.
The key things that let you look past the history are the demonstrated cost discipline, the stronger balance sheet, and that 61% gross margin. Those give them room to maneuver.
And then there's the external environment, which no one can control. The whole CBD category is still exposed to regulatory uncertainty.
That is the big external risk. But on the other hand, it's also the big external catalyst. If you're looking for leveraged exposure to potential reform,
This would be it.
any favorable federal reform rescheduling, safe banking, anything, would disproportionately benefit an established, branded, NYSE-listed player like this one.
So looking ahead, what's on the calendar? What's the next big data point we should be watching for?
The next major event is the mid-December earnings call. That's when they'll discuss the full audited fiscal 25 results. But really, the crucial part will be any commentary on fiscal year 26 guidance.
That's what's going to tell us if this trend can continue.
Exactly. And of course, you can't ignore the macro picture. The stock is benefiting from a broader sector rally tied to speculation about U.S. federal cannabis reform.
Which is speculative. We have to stress that.
It's always uncertain, but any positive headline there will lift the whole sector, and this company would likely act as a high-beta vehicle for that sentiment.
So this is really for a specific type of investor, isn't it?
It is. We're framing this as an asymmetrical high-beta turnaround story. It seems suitable for, say, a swing trade, or for positioning through that December earnings call. The full re-rating, where the market really buys the story, is probably on a 6 to 18-month horizon.
So it requires patience and a high tolerance for risk.
For sure.
This has been a really informative look at a company trying to move from distress to recovery.
The key decision for you, the investor, is whether you believe management can sustain this operational efficiency long enough to get from just cutting losses to generating reliable, positive free cash flow. That's what sets the stage for a critical 2026.
If you want to catch our analysis of that mid-December earnings call and all the future regulatory news in this high-risk, high-reward sector, make sure you subscribe right now. Don't miss the next move.